What's up everybody? Welcome to the Binance Futures tutorial. Now a lot of you have been asking for this tutorial to, illustrate things for you guys. So here it is, Binance Futures. So just before I get into, this visual tutorial, I need you to head over to Discord, right? If you haven't already, like seriously, if you haven't already read everything, okay? And I mean everything in the encyclopedia, you do not want to be watching this video right now, okay? Because this is like a fucking wealth of knowledge, right? If I spend so much time compiling everything for you and you don't even have the diligence to go through this, I do not want you to be watching this video right now. I want you to go through everything in the encyclopedia, okay? Over here, you're going to learn how to, manage risk, position sizing, difference between, fuck guys, this is a wealth of fucking information. This is probably better than some books that you're going to read without all the fluff, right? This is straight to the point without all the fluff. People literally would pay for this, and in fact, you paid for this, so get your ass in here and don't laze around, okay? I want you to read everything in the encyclopedia, okay? So let's dive into Binance Futures now. So first off, let's kick things off with what's the difference between USDT or if you realize, if you search let's say Bitcoin, right? There's two instances, right? There's Bitcoin USDT and then there's Bitcoin USD, okay? The only difference between both of these is that for USDT, you are using USDT as your collateral, okay? And for Bitcoin USD, you are using Bitcoin as your collateral. That means that when you enter into a position, I'm just going to go to Bitcoin USD. So when you enter into a position, you are risking your Bitcoin, okay? Which means that when you earn, you are earning in Bitcoin, and when you lose, you are losing in Bitcoin. So is there one that I would prefer over the other? Yeah, usually I like to trade on, it depends, right? It depends on what your goal is, right? If you are trying to, accumulate different coins, then you want to use Data USD, right? If you want to accumulate data, then do it on Data USD. All you have to do is, transfer collateral from your main account, from your spot, into futures. So as for which one I prefer, both. I use both. If I'm trading Bitcoin, I like to, if I have Bitcoin, then yeah, I'm trading on Bitcoin USD most of the time, right? But if my Bitcoin is all, parked in altcoins, then yeah, I'll accumulate USDTs. Either way, both work exactly the same. So you pick what is your goal, right? For me, accumulating Bitcoin is definitely going to be huge. It's just that usually, because Bitcoin is such a long-term holding for me, I like to accumulate USDT because I don't mind losing USDT, right? If I lose a trade, yeah, so what? I lost USDT. But Bitcoin, I'm trying to accumulate as much of that as possible. So usually I would trade in USDT and then I would use the profits in USDT to, accumulate more Bitcoin, buy more altcoins, and then convert it into Bitcoin, right? Because right now it's alt season, and if you don't know how to check if it's alt season or what, there is information in the encyclopedia. I want you to check that out, okay? So use both, and now we get into the difference between isolated and cross. So the only difference that, the first point that you should understand as a beginner, okay? If you're new to leverage trading, if you're new to futures, I want you to stick strictly to isolated, okay? The only difference between both of these, right? If in isolated, when you open a position here, everything that happens in that position is kept within that position, which means that if let's say you're risking $5 to open a position, any losses, I'm just going to do an example, right? If I just on market buy $1 worth of Bitcoin. So anything that happens within this, right? If you get liquidated here, then all you are losing is $1.66, okay? Compared to if you went on cross, right? That means that, let's say you have $100 and you put just $5 into opening a cross position. That means that when you lose, right? If the main difference, right? It's going to be the liquidation price. You'll find that, okay, over here, you see that the liquidation price is 31,600, right? Now, if I just market close this and, oh, by the way, you notice how I started out with $5 and even though I closed that position in profits, you notice that I have lost money. And that is because of a few things. First thing is market orders, right? You want to try your best to not close market, right? You want to try to close it on a limit if possible, because market, there's these automated market makers that, they do arbitrage, right? The moment you click on market, there's that, small 1-2 millisecond or maybe nanosecond delay between your order getting to Binance and filling it. So they will jump right in at that point, and oftentimes you'll find that you are losing money on market instead, and it's usually because of those arbitrage bots. So as much as possible, I like to use limit orders. Okay, so back to like cross, right? Okay, so right now I have a $5 account. Let's say I choose to risk $1. All right, let's say I choose to risk half of my account, so I buy. Right, same thing, right? I'm on 20x leverage, and look at this. My liquidation price is way lower compared to isolated. So why is that? The main reason is because when you're using cross, your entire futures account is used as collateral here, which means if I were to lose, right, if I were to hit the liquidation price at 28k, then I would lose my entire futures account, okay? And you are going to notice that if this position goes into the red right now, you're going to notice that, like, okay, just to prove that the market order thing, right? And this is how you take profits, by the way. You select how many percent that you want to close. By default, it is 100%. And then you select a price, and then you click on limit. That means that when the price hits your limit order, it is going to take profit. So let's say I hit limit, right? There you go. Which means when the price hits 33,200, it will close my position, right? 100%. And in this case, I actually gained, okay, because I'm not using market. It's just something to keep in mind. So that is the difference between cross and isolated. And this is why I say, as a beginner, you do not want to be using cross, because oftentimes what you'll find is when the price is like, I don't know, when the price goes into red, right? You'll notice that your total futures account is actually going to reduce, right? Even though you did not add anything into the position, you'll find that your futures account is actually going to decrease. And the reason for that is because you are using cross, okay? Your entire futures position, like your entire futures account, is used as collateral. That means that even though you are only using what, let's say 5% of your entire futures account in this position, if you get liquidated here, right, if it hits the liquidation price here, you're actually losing your entire futures account. Which means if you don't know what you're doing, or if you don't have the time to, monitor your positions, do not use cross. Like, I know the liquidation price seems very juicy, but unless you have a very large account or you are playing with small position sizes, right? Let's say I have $1,000 and every position is only what, $20, $50 collateral, then yeah, sure, go for it, okay? Because that is a small percentage compared to your total account. Under circumstances like that, yes, you can use cross, but under circumstances that are not, you want to stick to isolated, okay? Because on isolated, everything that happens in that position is just going to be restricted to isolated, all right? So I'm just going to open a market short order, all right? And this is how you short, by the way. You select your leverage, right? And then use your short, okay? And the difference between limit orders and market orders is simply, again, if I, let's say, want to short Bitcoin when it reaches 38k, and then I select my position, I just have to do this, right? And then a short order will be placed at 38k. Once Bitcoin reaches this price, the short order is going to be automatically placed. That is how you short, all right? Like the other difference, right? The reason why I say everything that happens in isolated is kept in isolated is because in isolated, let's say you want to reduce your liquidation price, right? In this case, I want to increase my liquidation price from 34k to, let's say, what, 35k? That way, I just have to click on this button right here to add margin. Okay, so let's say I add $2 worth of margin here. So once I add the margin, notice how my liquidation price increased. So this is basically like cross, right? Cross does it for you automatically, but in isolated, it is a manual process, and I would rather you do it as a manual process. However, I would rarely recommend you to increase margin, because doing so means that you are, holding on to a losing position, and you do not want to be stuck holding bags, all right? If you want to add to a losing position, do not do it on margin, okay? Do not add margin. In fact, buy lower, okay? Buy lower or buy higher. It depends on if you're shorting or longing. So the only way that you are going to be able to, buy lower or buy higher safely is by making sure that you dollar cost average smartly. You are not going to dollar cost average properly if, let's say, you have $500 to play with and your initial position is $400. You will have like $100 left to dollar cost average, and that is not a lot, right? When you're dealing with leverage, that is not a lot. Like, this is the difference between cross and isolated. I recommend using isolated because even if you lose, right, even if it hits this liquidation price right here, all I would lose is $3.64. I will not lose the remaining $1.33 in here. And again, I do not recommend adding margin unless you are doing some kind of long-term position. Then yeah, go for it. But usually I would like to keep my initial position small and add on to that position, as soon as the price turns against me. That way, let's say the price now heads to 35k and then I add to my position there. My position is going to be pulled higher. So the way you add to your position, right? If you are shorting, let's say if the price hits 33k 200, right? I want to add to my position. So when it hits 33k 200, I will limit, select my position size and short. Okay, this is how I add to my position. Why is it not working? 35 200 maybe? No, it's not working. I don't have enough margin. Okay, so now I remove margin. Okay, this is how you remove margin. All right, remove margin, confirm. So now your margin has been lowered and you have returned the money back into over here. And if you notice just now, when I returned the margin, it went from $2, right? Initially, I added $2 and now it was $1.97 because the price was turning against me. That means more and more of your margin is going to get locked up, which is why I do not recommend adding margin, okay? I would rather you add to your position instead of adding to margin. So now that I have $3 to play with, I can finally do a limit short. So this is how I add to my position, okay? Because I am shorting, the higher the price goes, the more red I'm going to be. So when the price reaches here, my position is going to, I'm going to add to my short here, and then my position is going to be dragged higher, maybe at 34k. So that is how you add to your position. Similar goes for longs. If you're longing, the lower the price goes, you add more as it falls, and then your position is going to drop. Okay, same thing. And then to deal with take profits, all right, remember previously, right? Let's say that you only want to close 25% of your position. So what you do is you select here and select 25%. Okay, notice that my position size is only 0.001 Bitcoin. So if I close, actually let's add to my position here. It's a bit hard to illustrate this. So let me mark it short. Okay, so now I have 0.002 Bitcoin. Not a lot, but it will make it easier. So if I want to close 50%, notice how it automatically selects it for me, right? If let's say I only want to close, let's say I want to close 100, right? Which is by default, it is going to set it at 0.002, okay? That's 100% of your position. So when you do take profits and stop losses, usually this will do it in one lump sum. So let's say I want to take profit at 25k. That means when the price reaches here, I'm going to make $16 off of this short, okay? And my stop loss, I'll set my stop loss at what, 35k? Wait, no, 35k is beyond my liquidation price. So 34k is my stop loss, right? Means when price hits this, I'm going to lose and I'm going to win here. Right, so I click on confirm and watch. So I have my stop loss here, and then I probably have my take profit down there. Do you see that at 25k? That is my take profit, and over here is my stop loss. However, like if you click on this part right here, it is going to take profit or stop loss for the entire position. So how do you do it in increments? So the way you do that is again by selecting how much you want to close, and then let's say I'm doing take profits, right? I'm doing take profits. Usually for stop loss, I just like to set it here because, you don't want to, usually for stop losses, I just set it like from here because I'm not planning to, close my position in increments, although you can, all right? You can close your position in increments, whether that be in the red or in the green. So the way, select how much you want to close. Let's say I want to take some profit at let's say I want to take some profit at 33,000, right? So I click on limit. All right, quantity is less than 1, so I have to do it like this. Boom. That means at this point right here, it's going to close 50% of my position. Okay, that is how you take profits. And let's say the price has turned against you and you want to close 20. In this case, it has to be 50. Let's say I only want to close 50% of my position. I can just do market or I could limit, right? Both works. And this is how you take profit and, close your position in increments in futures. So now, we go to selecting leverage, right? If you notice here, I believe you can adjust your leverage. I think it allows you to adjust your leverage. And I'm going to tell you right now that it doesn't work, okay? See this adjust leverage here? You cannot reduce your leverage, okay? Because, well, Binance. And I don't think Bybit allows you to reduce your leverage as well. You can increase it, however. So make sure you select, your leverage carefully before you jump into the position. Because once you're in it, you cannot switch. And Binance actually allows you to, switch your leverage upwards, right? It allows you to increase your leverage, but this will actually not increase your position size, okay? Notice if I move my leverage up to 50x, right? Notice how even after, right now, I'm on 50x, but my position size is still exactly the same. If you notice, right? The only thing that changes is the amount of margin that I can free up. Notice how before I would have had zero margin to be able to free up over here, but now I can free up $2 out of my, $3 position. So that's what increasing leverage allows you to do. It allows you to free up margin, but as you do, right? If I remove margin here, say I remove that $2, notice liquidation price, boom. All right, my position size doesn't change, okay? I'm just freeing up margin so that I can go into another position. And that is how you should think of futures, all right? So I don't believe there is too much else to say. I mean, other than trailing stops, I believe you know how to use trailing stops. If you don't, go on Google, stop limits, right? Stop market. I mean, stop limits is basically, you can just set it from here, right? And trailing stops, yeah, just set it from here, head to Google. And I think that's about it, right? Like, okay, actually, so if I were to close this position right now, by right, I should get 1.33 back, right? So by right, I should have 4.98, but let's watch. If I close it at market, right, boom, I lost way more than what I closed it at, okay? That is because of fees. If you don't remember, where's the fees, but yeah, for VIP0, right, this is a dummy account that I just made. For VIP0, right, this is the fees that you are going to be paying every time you open or close a position. And I just want you to know that the position size, right, it's actually not calculated based on your collateral. It doesn't mean that just because you put $5, the fee is going to be calculated against your $5 of collateral. In fact, it is calculated against your total position size. That means that if you're, let's say, using 10,000 USDs and you enter into, whatever on 10x, that means your position size is 100k. That means that when you close a position, you are actually getting charged 0.04% and 0.02% on 100,000. So you just need to keep that in mind, yeah? Which is also why you do not want to be using futures to, doing like scalps, right? 1-2%. Like in terms of futures, right? 1-2% is like what, 0.1, 0.2% in actual, spot. If you're just going to be doing that, don't use futures. You're gonna get absolutely wrecked by the fees. So stick to spots for those, short scalps. In general, I would say that unless you're confident that the price is going to move at least 1% in the direction that you are predicting, I do not suggest using futures in this case. So I believe that was quite an in-depth. Oh, right, funding rate. Can't forget funding rate. I do mention about this in the encyclopedia, but I'm just gonna shortly go through this. Binance has their own sort of explanation for what this is. And it says, like, basically all you need to know is when funding rate is negative, right? That means that long positions, right? People who are opening long positions are paying people who are opening short positions every 8 hours. And when the funding rate is positive, then short positions, all you need to know about funding rate is that when funding rate is negative, like it is right now, all this means is that there are more people shorting than there are more people going long. That means that the people going short actually have to pay the people who are going long about 0.012% of their entire position size to the people who are going long every 8 hours. And remember, again, this is why I do not like it when the market is being overly optimistic, because if funding rate is positive, that means that way more people are going long than they are going short. And if funding rate is like what, 0.01 or like 0.1, that means that when funding rate is above like 0.1 or something, like 0.2, 0.3, that is dangerous territory, right? Imagine paying like, let's say it was 0.3, right? Let's say you were going long on something. That means that you are literally paying 1% of your entire position size every 24 hours to the people who are going short, which means that if your position size is like 100k, you're paying 1k a day to whoever that is opening a short position. Like, you understand, right? I mean, that's one of the reasons why I do not like using futures to open up like long-term positions, because like you're paying so, like when people start getting greedy, right? The way that you can tell that the market is going to drop is by looking at the funding rate, okay? Because when funding rate is overly high, and I'm talking anything above 0.1%, then you know that the market is getting overly greedy, that is when you have to start being fearful, right? 0.1%, not yet. But 0.2, 0.3, maybe even 0.4, yeah, it's happened, even up to 0.6, right? When you see funding rate above like what, 0.2 or 0.3, get the fuck out, okay? Whales are going to come and see this and they're going to be like, oh my, that is a lot of people going long. And you have to remember, statistics show that most people who use futures are at least on 5x and above, right? Nobody uses futures for like 3x. Hey, that's like child's play, right? You either go big or go home. So that means that a price move of just 10% or even 20% would be enough to liquidate most people. So you have to be careful when funding rates are above like 0.2, 0.3, you will absolutely get wrecked, okay? If a whale just dumps on you, you are fucked. Because it's going to cause mass liquidations, which is also why when funding rates are this low, it means that there is a lot of fear in the markets. A lot of people are fearful of getting into the markets, of taking positions, which means price action is going to be really, really choppy because there's a lot of uncertainty in the markets, which makes it not fun. So that's how you use funding rate to your advantage. And like, seriously, keep an eye out on funding rate. I actually predicted that Bitcoin drop from, I don't believe, when was it again? I actually predicted like this 64k drop down to 48k, like at about this point right here. I actually predicted this because funding rate at this point right here was actually like, if I remember correctly, it should be hovering around 0.3 to 0.4%, which is absolutely ridiculous. Like absolutely ridiculous. I think at that point, the amount of longs to short ratio is probably like what, 30-40 times the amount of shorts. That means just a simple 5% price move or even a 10% price move is gonna bam, mass liquidations. All right, over here, bam, mass liquidations. The only reason why you see price drop like massively like this is because of mass liquidations. People are getting greedy at about these levels right here. They think that, oh, Bitcoin's going to go to the moon. And that is exactly when you should be exiting the markets. That is how you use funding rates to your advantage. And if you want to take this a step further, head over to Bevel 24 hours. Like either use 4 hourly or daily for this. I usually stick to 4 hourly. And then just draw the support line at 3. Okay, this is the Bitcoin historical volatility index. It just shows you that when it's reset, when it's down here, that means that Bitcoin isn't doing much. And every time, right, during every dump, you will see Bitcoin volatility increase, right, because price is moving really quickly. So whenever you see BVOL reset back to this support line right here, and you see funding rates are over like what, 0.2, 0.3, get the fuck out. Okay, I know it's tempting to be like, hey, Bitcoin's going to the moon, crypto is going to the moon. Trust me, I would rather you get out early than, suffer this kind of a drop. So let's take a look if there's anything else that I have not covered. And pretty much, I think that's it, right? That's a way more in-depth tutorial about futures than I expected. But yeah, here it is. I hope you guys have no issue with futures. Like, just remember, right, position sizing. If my usual position sizing was, what, $1,000, that means that I could enter with $50 on 20x and I would get the same $1,000. Futures is a way to allow you to trade the markets both ways and to expose yourself to more positions at the same time. That is all it is, right? It's not a way for you to get rich quick by, let's say your account size is $1,000 and you go in 20x. I'm using 20k. I can get rich, right? Just 100% in any direction is going to get you 1k. It doesn't work like that, okay? If you do that, trust me, at some point you are absolutely going to blow your account up. Make sure you manage risk properly on futures and remember to always always have stop losses, right? In spot, if you don't have a stop loss, that's fine. But in futures, you have to have a stop loss, okay? Because everything in futures moves really quickly. If you don't have a stop loss, you are gambling. And if you are gambling, I am not responsible for anything that happens. Yeah, I've given you exact guidelines on how to calculate your position size and everything. So use this knowledge to your advantage and don't get fucking wrecked on futures. And if you're new, right? If you're new to futures, I would say you don't have to shy away from futures. Just remember the rule to keep about 80 to 85% of your total portfolio in spot and just keep about 10 to 15% of your account portfolio in futures. So the way I use futures is, while I build my long-term spot positions and while they are gaining value over time, I use futures to, attain more USDT so that during dips, I can use the USDT that I've accumulated from futures and put it back into spot, right? That's how you that's how you use futures. At least that's how I use futures. And if you're new to futures, I would say you don't really have to get scared about leverage trading, because again, it doesn't matter if you are new or if you are, experienced. Position sizing and risk management should be the same for everybody, which means even if you're new, as long as you're using the proper position sizing, right? Just calculate how much of a position that you would usually want to take and just, multiply that by your leverage and you should be fine. So don't shy away from futures, right? It's a very powerful tool in any experienced trader's tool belt. So learn to get familiarized with it and use it to your advantage, right? As long as you're managing your risk well, you are not going to get wrecked on futures. And just remember to set your stop losses and move it to break even once, take profits are hit. So yeah, I think that's it, guys. As usual, may the gains be with you, and don't be scared of using futures.